In the autumn of 1982, the United States economy was already deep into recession. Unemployment had moved above 10%. Construction sites were idle. Manufacturing output had fallen sharply. Interest rates, which had reached levels not seen in modern financial history, were only beginning to decline. For many households and businesses, the damage had already been done. The decisions that produced this outcome had been made several years earlier, under conditions that were less visibly severe but more structurally fragile. At the center of those decisions was the Federal Reserve, and at its head was Paul Volcker. Problem Volcker confronted was not sudden. Inflation in the United States had been building for more than a decade. By the late 1970s, it was no longer viewed as a temporary disturbance. Consumer prices were rising at double-digit rates. Wage negotiations assumed ongoing price increases. Long-term contracts embedded expectations of erosion in purchasing power. Inflation was no longer an event. It was a condition. Markets operated within it. Institutions adapted to it. Policymakers spoke about managing it rather than eliminating it. This environment had emerged from a combination of forces. The breakdown of the Bretton Woods monetary system in the early 1970s removed the dollar's formal link to gold. Oil price shocks amplified cost pressures across the economy. Fiscal policy had been expansionary for years, shaped by war spending and social programs. Monetary policy, constrained by political pressure and competing objectives, had often accommodated price increases rather than resisting them. Each episode of tightening had been brief and reversible. Inflation retreated temporarily, then returned at a higher level. By the time Volcker was nominated as chairman of the Federal Reserve in 1979, confidence in the institution was strained. The central bank was seen as reactive and hesitant. Inflation expectations were poorly anchored. Long-term interest rates reflected skepticism that price stability would be restored. The credibility of monetary policy itself had become part of the problem. Volcker arrived with a reputation shaped by his experience at the Treasury and the New York Federal Reserve. He was not identified with ideological movements or academic schools. His views were formed by observation rather than theory. He believed that inflation, once embedded in expectations, could not be reduced gradually without being reignited. Incremental adjustments, in his view, signaled unwillingness rather than resolve. The Federal Reserve operated under a dual mandate: price stability and maximum employment. In practice, these goals often conflicted in the short term. Volcker understood that reducing inflation would likely raise unemployment and suppress growth. The question was not whether costs would occur, but whether the institution would accept responsibility for imposing them. In October 1979, the Federal Reserve announced a change in operating procedures. Rather than targeting short-term interest rates directly, it would focus on controlling the growth of the money supply. The distinction mattered less for its technical implications than for its signaling effect. Interest rates would be allowed to move freely, even sharply, if that was required to restrain monetary expansion. The central bank was removing its own discretion to smooth outcomes. Markets responded quickly. Short-term rates rose, volatility increased, borrowing costs became unpredictable. For businesses accustomed to stable financing conditions, the adjustment was disruptive. For households, especially those reliant on credit, it was painful. Mortgage rates climbed into the high teens. Auto loans became difficult to secure. Investment slowed. The initial reaction was not uniformly supportive. Political pressure intensified as the economic slowdown deepened. Members of Congress criticized the Federal Reserve openly. Agricultural states, heavily dependent on credit, were especially vocal. There were calls to reconsider the approach, to ease conditions, to balance priorities more carefully. The costs were visible. The benefits were not. Within the Federal Reserve itself, there was disagreement. Some officials questioned whether money supply targeting could be implemented with sufficient precision. Others worried that the institution was overcorrecting, risking unnecessary damage. Volcker listened, but he did not reverse course. His position was that credibility, once lost, could only be restored through consistency over time. Inflation did not fall immediately. In 1980, price increases remained elevated. This tested the strategy. If inflation persisted while unemployment rose, the political justification for restraint weakened further. For a period, the economy appeared to be absorbing the costs without delivering the intended result. What shifted was not a single data release, but a gradual change in expectations. Businesses began to alter pricing behavior. Wage demand softened. Long-term interest rates stopped rising and began to stabilize. The belief that inflation would continue indefinitely started to erode. This process was uneven and difficult to measure, but it was observable in financial markets. The recession intensified in 1981 and 1982. Industrial production declined sharply. Entire sectors contracted. The social impact was significant, though unevenly distributed. Volcker acknowledged the severity of the downturn, but he resisted calls for rapid easing. His concern was that premature relief would confirm the pattern of the previous decade. Tightening followed by retreat, leaving inflation intact. By late 1982, inflation had fallen substantially. The annual rate dropped into single digits, then continued lower. This allowed the Federal Reserve to reduce interest rates. Economic activity began to recover. Over time, unemployment declined. Growth resumed. The immediate crisis passed. In retrospect, the period became associated with a clear outcome. Inflation was broken. But this framing simplified the complexity of what occurred. Inflation did not vanish because of a single decision or a single individual. It receded because expectations changed. And expectations changed because an institution demonstrated willingness to accept short-term damage in pursuit of long-term stability. The costs of that demonstration were real. The recession was one of the deepest since the Great Depression. Communities dependent on manufacturing experienced lasting decline. Small businesses failed. Borrowers defaulted. These outcomes were not unintended. They were accepted as necessary. The political context also mattered. The early 1980s marked a shift in the broader policy environment. Fiscal policy became more supportive of growth. Deregulation altered competitive dynamics in several industries. Global capital flows increased. These factors interacted with monetary restraint in ways that were not fully anticipated. Volcker's role has often been described in personal terms: resolve, toughness, independence. While these attributes were relevant, they do not fully explain the outcome. The Federal Reserve's authority, though significant, was not absolute. Its actions were constrained by institutional design, legal mandate, and public tolerance. The success of the disinflation depended on these constraints holding. It also depended on the absence of a competing crisis. External shocks, such as a major geopolitical disruption or a banking collapse, could have forced a different response. That they did not occur during the critical phase was not the result of planning. Later interpretations tended to focus on lessons. Some argued that central banks should always prioritize price stability. Others warned about the social costs of aggressive tightening. Both perspectives drew selectively from the same period. What was often lost was the specificity of the circumstances. Inflation in the late 1970s was not merely high, it was entrenched. It reflected a breakdown in the perceived limits of policy. Restoring those limits required more than technical adjustment. It required a change in how the central bank was understood. Volcker himself resisted simplification. He did not present the episode as a model to be replicated mechanically. He emphasized judgment, context, and institutional credibility. He understood that the authority he exercised was partly borrowed from circumstances that could not be recreated at will. By the time he left office in 1987, inflation had remained low for several years. The Federal Reserve was viewed differently. Markets assumed that price stability would be defended. This assumption became embedded in financial contracts and economic planning. The memory of the early 1980s shaped behavior long after the conditions that produced it had faded. The system adjusted, as it often does. Inflation receded into the background. Monetary policy became quieter, less visible. What remained unresolved was not the effectiveness of the intervention, but its cost, and the extent to which that cost could ever be imposed again under different conditions.